Welcome to Inside the Economist's Mind. Today, we follow Australia's high-stakes economic race. For decades, the Reserve Bank of Australia's rate decision has clashed with the Melbourne Cup on the first Tuesday in November, and now the economy itself is facing a horse-racing dilemma. The recovery in GDP growth began with the highest level of capacity utilization in over 40 years. Deputy Governor Andrew Hauser asks the big and pressing question, is Australia trapped on the economic rail, boxed in by its own capacity constraints, unable to surge forward? Or will it find ways to break free through higher productivity and investment, making it off to the races? Okay, let's unpack this dilemma. We're diving into the economic outlook presented by the Deputy Governor of the RBA and using this really vivid framework of a horse race to map out Australia's potential economic future.
Yeah, and the stakes are genuinely high here because the starting point for this particular race, well, it's probably one of the oddest situations we've seen in Australian economic history.
It really is. But before you even get to the economy, that tradition you mentioned, the RBA versus the Melbourne Cup, that's quite something.
Oh, it's fascinating, isn't it? Just the sheer stubbornness of it. For decades, you had this friction. The RBA and the Victoria Racing Club both wanting that first Tuesday in November.
The ultimate calendar clash. A bit bizarre.
It really is. And Hauser mentioned, newspaper editors back in the day, they absolutely loved it. All those rates gallop ahead headlines.
Yeah.
Very dramatic.
Makes for good copy, I suppose.
Exactly. But if you actually look at the data, the history, it's often been a bit of a damp squib, frankly. Melbourne Cup Day has seen the RBA hold rates steady far more often, or, interestingly, cut them.
Cut rates on Cup Day.
Yeah, big cuts, too. Think 1991, 1996, 2008, during the GFC. So the actual drama was often just in the headlines, not the RBA's boardroom.
Well, the economic drama now is definitely not confined to headlines. Let's set the scene. How did Australia get to this very peculiar starting line? Just rewind a bit. About a year ago, mid-2024, GDP growth basically hit the floor, right? 0.1%.
Yeah, rock bottom. And understanding that period means understanding the RBA's quite unique path. You see, globally, most other central banks were hiking rates really aggressively to fight inflation.
Slamming on the brakes.
Pretty much.
Yeah.
But the RBA, they chose a different strategy. More cautious, less aggressive tightening right at the start.
And that cautious approach, maybe combined with a bit of good fortune, seemed to work out okay.
It did. I mean, those really gloomy scenarios everyone was talking about, they just didn't quite happen.
Like the trade war fears.
Exactly. The worries about a new U.S. administration hitting China, Australia's biggest partner, with big tariffs, turned out to be, well, smaller and narrower than feared. Global trade is surprisingly resilient. It rerouted. Commodity prices stayed pretty firm.
So the big confidence shock in Australia never really landed.
Not in the way people feared. And the result was actually quite positive. GDP growth picked up noticeably from September 2024.
Driven by
private domestic demand, mainly. And crucially, employment kept growing strongly. Australia's job market remained, higher and more stable than many comparable economies, especially looking back to pre-pandemic levels.
Right. And that success, that growing confidence that inflation was actually heading back towards the target range, that allowed the RBA to start easing policy a bit.
Precisely. They cut the cash rate target by 75 basis points, spread out between February and August 2025.
A reward for getting inflation down without a recession.
You could see it that way. And those cuts are pretty important for what happens next. They're expected to support growth, especially later in 2025, just as the boost from public spending starts to, fade away.
Okay, but that success story, getting inflation down while keeping people in jobs, it came with a sting in the tail. A side effect.
A major one. And this is exactly where that horse racing analogy stops being fun and starts getting, well, a bit terrifying.
Because we're not just at the starting gate looking ahead.
No. It's like we've just realized the horse somehow already ran the first lap flat out. And now there's no room left to accelerate. We're already pushing the limits.
Explain that. What does that mean in economic terms?
Well, usually when an economy starts recovering, there's what economists call a negative output gap. Basically spare capacity.
Like having extra gears you haven't used yet.
Good analogy. Or think of it like an engine running at, say, 4,000 RPM. When its red line is 7,000, you've got room to speed up without overheating the engine, without causing inflation.
But this time, it's different.
Drastically different. The core finding, the really unusual bit, is that this recovery in GDP growth, it started when capacity utilization was already at its highest level in over 40 years.
40 years, so back to the early 80s.
Exactly. The RBA's central estimate suggests Demand was actually running slightly above the economy's potential output, its sustainable speed limit, right when growth started picking up.
So the engine was basically redlining from the get-go.
That's it. The tightest starting point for a recovery since the early 1980s. And look, this isn't just some abstract model telling us this.
There's real-world evidence.
Yeah, the NAD Business Survey, for instance. It showed firms reporting capacity utilization well above the long-run average right at the start of this recovery period. Businesses were already feeling stretched thin.
Okay, so why? Why is the economy so constrained? You said it wasn't runaway demand recently. GDP growth has been okay, but not spectacular.
No, it's not about a sudden demand surge. It's more the cumulative effect of weak supply growth over several years. The economy's potential hasn't kept pace.
Right, the supply side. So we're talking about fundamental limits on how fast Australia can grow.
Exactly. We're talking about the economy's potential output growth. That's the safe speed limit, the rate it can grow without sparking inflation.
Yeah.
And the estimates show it fell sharply,
How sharply?
from about 2.5% a year before the pandemic, down to just 1.5% during the 2020 to 2025 period.
Hang on, let's slow down there. A drop from 2.5 to 1.5% in potential growth. That sounds like jargon, but what does it actually mean for people? Is this why things feel sluggish?
It's absolutely fundamental. It's not just jargon. It's the underlying reason growth feels constrained and maybe why wage growth hasn't been stronger for longer. That full percentage point drop reflects a big downward revision in what we call trend productivity growth.
How much we produce per hour worked.
Precisely. It's estimated to have dropped from about 1% a year down to just 0.7% annually. Now, 0.3 percentage points might not sound like much.
But compounded year after year.
It's huge. It means we're getting significantly less efficient, producing less output for every hour we work. The economy's underlying ability to grow, think new factories, better technology, innovation, it seems to have slowed down.
And that's why the deputy governor says the economy feels fundamentally boxed in.
That's the core of it. We're trying to accelerate, but we're hitting capacity limits much, much sooner than we normally would.
And these limits, these constraints, they're causing confusing signals now. Mixed messages for the RBA.
Totally confusing. Look at the recent data. Underlying inflation ticked up to 3% in the year to September. That's higher than expected, suggesting things are tight.
Okay, points to constraints.
But unemployment also rose, hitting 4.5% in September. And rising unemployment usually signals there's spare capacity, not a lack of it.
Huh. So inflation is sticky, maybe going up, while unemployment is also rising. How does that work?
That's the policy nightmare. It throws up this massive question. Are we genuinely hitting the economy's absolute limits? Or is there actually more hidden slack, more spare capacity than the main models are telling us?
Which leads us straight to the deputy governor's 3 tracks, the possible paths ahead for this economic race. These basically frame the whole policy debate right now.
Yeah, you can think of them as the 3 horses the RBA is trying to bet on, or at least understand the odds for.
Okay, let's take them one by one. First up is Track A, still ground to make up. This view basically says, maybe those capacity estimates are too gloomy. Maybe the economy isn't as tight as we think.
Right. This track suggests there might still be room, maybe even a need, for further policy easing, rate cuts, because there's more slack hidden away.
What's the evidence supporting Track A? Why might we think there's more room?
Well, the main argument revolves around the consumer. Look, at consumer confidence is still really low, way below historical averages. If people are still hesitant to spend, maybe underlying demand isn't that strong.
And the unemployment rate rising.
That's another key piece of evidence for Track A. It suggests the labor market might be cooling faster than the headline output numbers suggest. Maybe firms are holding on to staff for now, but the underlying weakness is there. Also, perhaps that recent inflation pickup was just temporary noise, not a sign of real pressure.
Okay, that's Track A. Maybe there's more room to run. Then there's Track B, boxed in on the rail. This is the more pessimistic take.
This is the view that takes those capacity constraints, that redlining engine, really seriously. It says, look, we are genuinely constrained.
And the implication is little or no room for more rate cuts.
Exactly.
Yeah.
Any further easing risk pushing inflation back up quite quickly because there's just no spare capacity to absorb it.
What data points towards Track B being the reality?
Well, several things. That September inflation pickup. It wasn't just 1 or 2 quirky items. It was pretty broad-based across different spending categories. That suggests wider pressures.
Okay.
Financial conditions might not actually be restrictive anymore. Think about it. Credit spreads are low, banks seem eager to lend, and the cash rate itself is now below where some economists estimate the neutral rate should be.
So policy might already be accommodative, or at least not tight.
Potentially. Plus, businesses still consistently report major difficulties finding workers. Ongoing recruitment problems suggest real tightness persists, at least in significant parts of the labor market. And private demand picked up faster than forecast earlier.
Okay, so track A says maybe cut, track B says hold tight or even think about hikes. If you're the RBA facing this conflicting data, where do you lean? Which track looks more likely right now?
That's the million-dollar question.
Mhm.
And Hauser was quite open about this dilemma. He indicated the RBA's current central forecasts lean slightly towards track B, the boxed-in view.
Why?
Mainly because those capacity constraints look so historically tight, it's such an unusual starting point they have to take it seriously. But, and this is crucial, they fully acknowledge the strong points supporting track A.
Especially the rising unemployment.
Exactly. That rise in unemployment stops them from just dismissing the possibility of hidden slack. So their next policy move becomes incredibly sensitive to the incoming data over the next few months. Every jobs report, every inflation print is magnified.
So if track B being boxed in is the most likely scenario, or at least the one they have to plan for, that leaves only one way forward for sustainable, faster growth, right? That's track C. Off to the races.
That's the escape hatch. Track C says, if we're truly boxed in by capacity limits, the only way to achieve higher growth without overheating is to expand that capacity.
How?
Through a big pickup in investment and productivity growth. Essentially, rebuilding the economy's potential.
Because right now, the RBA's own projections, they're not exactly stellar, are they?
No, they assume growth is capped, non-inflationary growth anyway, at only around 2% over the next couple of years. That's pretty sluggish by historical Australian standards. Stagnation, almost.
So to break out of that 2% rut, we absolutely need investment. But
Are we getting it?
that's the problem. Currently, no. Real business investment has basically been flat for the last 18 months.
Flap.
Yeah. And when businesses are surveyed about their spending intentions for the next financial year, 2025-26, they suggest little or maybe even no growth. Private investment as a share of the economy is still way below where it was during the mining boom peak.
So we need investment to break free, but it's not happening. It sounds... It is. And it's genuinely ironic, almost paradoxical. Because Australia isn't lacking the resources to fund this breakout. We're incredibly capital-rich on paper.
But capacity poor in practice.
Precisely. Hauser listed Australia's incredible assets, the potential energy we have. It's quite a list.
Let's run through them, because this is the why we should be optimistic part, right? The
Yeah.
potential for track C.
Absolutely.
Hmm.
First, extraordinary mineral resources. Yeah. Not just the traditional ones, but also the new ones, crucial for the global energy transition. Lithium, rare earths, etc.
Okay, what else?
World-leading universities, fantastic human capital that's the engine of innovation. A really advantageous geographical position in the Asia-Pacific, the world's fastest-growing region.
And the money. Does Australia have the financial firepower?
Immense firepower.
Yeah.
A huge pool of domestic savings. Hauser noted Australia has the second largest median wealth per person globally. Think about that.
Uh-huh. Second globally.
Yep. And the fourth largest pension system in the world, all that superannuation money. Plus, compared to other major economies, a very low level of public debt, a strong, stable banking system, reliable institutions.
So the pieces are there. The raw materials, the brains, the location, the money, the stability.
All the ingredients. That enormous pool of domestic savings, especially our superannuation funds, could theoretically fund a massive wave of investment in infrastructure, technology, and capacity expansion.
So connecting the dots, seizing that opportunity, actually deploying those resources effectively, attracting that investment. That's the only real way to shift the dial on potential growth.
It's the only sustainable way. It's how you expand productive capacity significantly and get back to higher growth rates, maybe 3% or more, without immediately hitting that inflation wall again. That's the off-to-the-races scenario.
Okay, let's try and bring this all together for the listener. What's the key takeaway here? Australia's economy has pulled off something pretty remarkable, hasn't it?
It really has.
Yeah.
Getting inflation down sharply, one of the fastest disinflations in decades, without triggering a recession and while keeping employment high. That's a major success compared to many other countries. But that success seems to have used up all the slack, all the spare capacity in the economy, the margin for error going forward. It looks incredibly thin, maybe close to zero.
So the big challenge now for the medium term is crystal clear.
Absolutely. It's all about supply. How do we create more capacity? How do we boost productivity and investment? If we fail to do that, We're likely stuck on track B, boxed in, limited to that slow, maybe 2% growth path for the foreseeable future.
But if we do succeed, if Australia manages to unlock that investment, leverage those amazing assets we just talked about, and really boost productivity.
Then we genuinely could be off to the races. A much faster, more sustainable, more prosperous growth path becomes possible.
It's quite fitting, then, that the deputy governor finished his speech with that little anecdote connecting the two types of races.
Yeah, the fact there's an actual racehorse in Australia named Reserve Bank. Apparently it's 4 years old.
And racehorses usually peak between 3 and 5 years old.
Makes you wonder, doesn't it? Is the economic race nearing its peak urgency too?
Which leads perfectly to our final provocative thought for you, the listener.
Given everything we've discussed, Australia's incredible, almost unique blend of massive domestic wealth and resources, sitting alongside this urgent need to solve the productivity puzzle and unlock faster growth. Which race is actually harder to win?
The Melbourne Cup itself, with all its chaos and luck.
Or this economic race, the challenge to finally break free from being boxed in by capacity constraints and truly get off to the races? Something for you to ponder.